Hey everyone, and welcome to this explainer on ASC 235, Notes to Financial Statements. Today we are tackling Section 5 of 7, Commitments, Contingencies, and Disaggregation. I am super excited to get into this one because we're taking a really unique hands-on approach to looking at these financials. Think of it like we're equipping ourselves with two tools, a radar and a magnifying glass. We're going to use our radar to sweep the horizon for those hidden future obligations, and then we'll use our magnifying glass to zoom way in and unpack the massive aggregated numbers sitting right there on the balance sheet. So let's jump right in.
Okay, let's look at our roadmap for today. We'll start with context and course connection, move into commitments and contingencies, and then highlight a common audit mistake. After that, we'll cover disaggregation, run through key line item disclosures, and finally wrap it all up with a summary and a peek at the next lesson.
Section 1, Context and Course Connection. It is absolutely vital to see how everything we're learning fits together into the bigger picture. Now, if you remember our previous lesson, we covered notes that were specifically triggered by distinct events or relationships. Things like post-period events, substantial doubt about an entity's viability, and related party transactions. But today, we're shifting gears. In this current lesson, we're transitioning to notes that act like an early warning system, scanning for future obligations that aren't quite on the balance sheet yet. And on top of that, we're looking at notes that require us to zoom in on the granular, economic details of the aggregated data that already is on the balance sheet.
Section 2, Commitments and Contingencies.
All right, this is where we power up that radar I mentioned earlier. We are scanning outward for obligations that haven't hit the balance sheet yet, but they have very real, very significant future impacts. Typically, the Commitments and Contingencies note will combine cross-references to other notes with standalone disclosures for items that just don't qualify for accrual right now. So the crucial point here is understanding the difference in certainty between these two off-balance sheet items. A commitment, that's an obligation that is certain. It's happening, but it's currently immaterial for balance sheet purposes. A contingency, on the other hand, is an uncertain obligation. We know there's a potential exposure out there, but the final outcome is still totally unresolved. And this list brilliantly illustrates exactly what we are looking for with our radar. There are 6 main categories you need to be tracking for this note. Let's look at legal proceedings first, because it's a great example. Imagine a company is facing a massive pending lawsuit. It hasn't been settled, so obviously a finalized liability isn't sitting on the balance sheet yet. But the note still has to disclose all material pending or threatened litigation. You have to include a description of the claim, the current stage of the proceedings, and either a range of possible loss or a flat-out statement that no estimate can be made. It's really all about giving the user a heads up. The other categories follow that exact same logic. You've got lease and purchase commitments, guarantees, where you have to disclose your maximum potential exposure, environmental obligations, warranties complete with a roll forward of the liability, and finally, insurance programs, like self-insurance or any significant uninsured risks.
Section 3, the common audit mistake.
I want you to pay very close attention to this part because we are looking at literally one of the most frequently cited audit findings when it comes to note disclosures. Ask yourself this question whenever you're preparing or reviewing these statements. Did you only disclose what you accrued? Look, it's a completely natural instinct. As financial professionals, we're basically hardwired to focus on the concrete numbers, the liabilities that have a definitive journal entry and sit squarely on the balance sheet. But relying on that instinct right here, it will lead you straight into a trap. As this quote clearly spells out, the commitments and contingencies note absolutely must cover both probable items, meaning the ones you already accrued, and reasonably possible items. That includes items with zero balance sheet entry whatsoever. Omitting those reasonably possible contingencies isn't just a tiny, minor oversight. It is a critical failure point that auditors will flag immediately. So keep that radar sweeping for the reasonably possible.
Section 4, Disaggregation, unpacking the numbers.
Okay, we are officially putting away the radar and pulling out the magnifying glass. Now we're shifting our focus inward to break apart those massive aggregated numbers so that users can actually understand the real details beneath the surface. Let's look at a prime example, revenue. Under ASC 606, you have to disaggregate revenue into categories that best illustrate how economic factors affect it. The common ones include product or service type, geography, contract type, and timing, like point in time versus overtime. Now, ASC 606 does give preparers some flexibility in choosing these categories, but be incredibly careful here. Think about it. If a company sells in multiple geographies with vastly different risk profiles, using one single broad category like product revenue completely masks their true economic exposure. The categories you choose have to honestly reflect the actual economic reality of the business.
Section 5, Key Line Item Disclosures.
Of course, revenue isn't the only number that requires our magnifying glass. Now, what's really interesting about these specific line items is how breaking them down provides true, actionable economic visibility. Take long-term debt, for instance. A single giant aggregated number on the balance sheet tells you almost nothing about the company's actual risk. To get the real story, the note must show the principal, the interest rate, maturity, collateral, and covenants for each significant instrument, plus an annual maturity schedule for the next 5 years. For accounts receivable, we need to see the gross receivable, the allowance for credit losses roll forward, and any concentration of credit risk. Inventory needs to be sliced up by raw materials, work in process, and finished goods. Intangible assets and goodwill. They need detailed roll forwards. And income tax expense has to be split between current and deferred, complete with an effective rate reconciliation. It's exactly this granular level of detail that transforms a simple, flat summary into a truly actionable financial document.
Section 6, Summary and Next Lesson.
Let's pull all of these concepts together. To summarize, in today's explainer, you've mastered revealing hidden risks through commitments and contingencies, using your radar. And you've learned exactly how to unpack aggregated data through proper disaggregation, using your magnifying glass. In our next lesson, we are going to look at error corrections, note structure, and some key differences between US GAAP and IFRS. We'll cover how to properly account for and disclose prior period errors and accounting changes, as well as the conventional ordering of these notes.
Before we wrap up this explainer, I want to leave you with one final provocative question to chew on. Are your aggregated numbers hiding your true economic story? It's a critical question, and one that demands absolute transparency from financial professionals. Thank you so much for joining me today, and I absolutely can't wait to continue our deep dive in the next explainer.